If you're someone looking to earn passive income by investing in the stock market, one of the options that could be offered to you would be to invest in great covered call ETFs. It is why in this video, you'll find some of the absolute best Canadian covered call ETFs in which you can invest right now if you're looking to earn some extra income every single month. But first, before we see what are those ETFs, we need to understand what are covered call ETFs. Covered call strategies involve holding a certain security and at the same time selling different call options on it. A call option is an option giving the possibility to the buyer to buy a certain specific asset like a stock at a predetermined price called the strike price within a certain time frame until the expiration date. It means that if the market gains value after you've decided to buy the call option, the big beneficiary of it obviously will be you, because let's say that you decide to buy some call options on Apple with a strike price of $200 per share and that the value of the shares of Apple rise to $230, it will mean that on your side, you'll have the possibility to buy a certain number of shares of Apple at the strike price of $200 while it is still worth $230, so you'll make a profit of $30 per share on it. However, it is also important to note that there is one big specificity to these types of options. It is the fact that even if you don't use your call option throughout the specific period of time that you have, you will still have to pay a certain premium to the seller. It is why by selling these options, the seller will be able every single month to receive some extra income from the premiums of the buyers. And one of the big pros of the covered call strategy is the fact that it also comes reduce the overall risk of your portfolio, since you'll also have a long strategy on the underlying asset, meaning that you will also hold the assets on which you are selling the different call options. So it will help you to soften your total losses during big downturn momentum, while however it won't help you to maximize the total return that you could be able to make in great momentum markets. And at the same time, you'll still have a certain risk related to the underlying assets when you are using this type of strategy. Now that you understand what is a covered call strategy, let's take a look at what are the best covered call ETFs that are currently available for all Canadians. Starting out with the best Canadian covered call ETF tracking the US market, which is the Hamilton Enhanced US Covered Call ETF with the ticker HYLD. On its side, this fund has the objective to basically replicate the performance of an overall sector mix broadly similar to the S&P 500. The S&P 500 is basically a great overview of the US economy by tracking the 500 largest American companies by valuation. On its side, this fund is distributing close to 14% of annual dividend distributed on a monthly basis. In terms of the different holdings of this fund, with no surprise, we find that the largest sector is by far the technology sector with close to 30% of the total assets. And then after we find that the healthcare and the financial sectors are the two other big sectors of this fund. It makes that in terms of their holdings, we see that they are only investing in other different Hamilton ETFs, where we can see that the vast majority of their assets can be found into the SMAX ETF tracking the US equity and into their QMAX ETF tracking the technology sector in the US market. What is also pretty interesting about the different covered call ETFs from Hamilton is the fact that they are saying that their management fee will be of 0%, but that they will be subject to the fees of the underlying portfolio ETFs. It is why to find the exact management fees that you'd be paying, we would need to go see and make an average of all of the different funds in which they are investing. So if we take the largest ETF in that case, which is the SMAX ETF, we can see that the total MER of this fund would be of about 0.65%. So if we would take the fact that HYLD would have the same management fees, meaning 0.65%, this would present some fees of about $65 per year of fees on a $10,000 investment. Obviously, you can see that these fees will be quite higher compared to classical ETFs such as VFV, because basically it needs to be actively managed by the fund manager, notably to trade different options on it. And now if we take a look at the total return, so this includes the dividends and the total unrealized capital gain that you would have been making throughout a certain period, we can see that over the past couple of months, the performance of HYLD hasn't been that great, where we can see that year to date, it has been of less 5.39%. However, over the past 365 days, you can see that it has returned over 7.30% of total return. And since the inception of this fund, the total return on average per year was of about 5%. So it is still quite lower compared to other ETFs such as VFV, but let's see the second ETF on my list, which is actually the Hamilton Multi-Sector Covered Call ETF with the ticker HDIV. On its side, this fund, in my personal opinion, is the best one to track the global Canadian market, where it has an objective to track a sector mix broadly similar to the S&P TSX 60, which is the index for the Canadian market. And on its side, you can see that its distribution yield on an annual basis is of close to 12% that is distributed on a monthly basis. In terms of the asset allocation, with no surprise, we find that the largest sector of this fund are the financial sector, followed by the technology and the energy sectors, as it is for the global Canadian market. And once again, HDIV also only invests in Great Hamilton ETFs, where we can see that the three largest ones are Hamilton Enhanced Canadian Financial ETF, the Hamilton Technology Yield Maximizer ETF, and the Hamilton Canadian Financial Yield Maximizer ETF. If we do the same exercise as previously, we go see the largest one, which is HFIN, that has currently an MER of about 0.65% once again. So once again, you'd be paying about $65 for a $10,000 investment in HDIV. And unlike the previous fund that I've just presented to you, we can see that recently this ETF has been able to perform quite well, where it has been up of about 2.66% year to date, unlike the overall market. On 1 year, this performance has been excellent, with some return of over 17%. And since the inception of this fund, we can see that this has been able to return over 13% on average, which is actually bigger than the global S&P 500 historical return. Finally, for the third and last ETF that I wanted to present to you today, I want to go with another issuer than Hamilton. So I've decided to go with the BMO Covered Call Canadian Banks ETF with the ticker ZWB. This one is great because not only you'll be making great income from the sales of the premiums of this fund, but also from the different companies in which you are investing by investing in this ETF. In fact, as you've been probably able to understand from the title and the name of it, this one is mainly investing into the Canadian banks. It is why we can see that in the largest holdings of it, the largest one is the BMO Equal Weight Banks Index ETF, which is basically the BMO ETF tracking all the biggest Canadian banks. And add to this, we can also see that they are investing directly in other of the biggest Canadian banks, so the Canadian Imperial Bank, the TD Bank, RBC, the National Bank, as well as the Bank of Nova Scotia. And at the end of the total asset allocation, we can see all the different call options that are currently ongoing. On their side, the ZWB ETF is also distributing about 7% of annual dividend that is also distributed on a monthly basis. But on their side, it is important for you to understand that you'd be paying slightly more fees compared to the two previous ETFs, so about 0.71% or $71 per $10,000 invest. And if we take a look at their past performance, we can see that over the past year, they've been able to return about 9.51%, even if year to date, their total return has been of only less 3.84%. Nevertheless, since the inception of this fund, we can see that on average per year, it is returning about 8% to their shareholders. So there you have it. These were some of the absolute best Canadian covered call ETFs in which you can invest in right now. While covered call ETFs might be great for people such as retirees that are looking to earn more extra income every single month, these ETFs are not necessarily the best ones if you're looking to grow as much as possible your total portfolio value over a certain long period of time by having the best total return. It is why if you're looking to find some of the absolute best Canadian ETFs to maximize your gains on the long term, you can check out the video that's going to be right over here, and I will see you soon. Peace!